Thank you so much for joining me today, especially on a Saturday. So I'm 𝐓𝐿𝐴 from Nikko AM ETF Business Development Team. So today I'll be sharing with you two of our new ETF. The first one is the Amova MSCI Asia X Japan X China ETF. I'm sure you have heard a lot about China just now. So here's something different for you. It's Amova X Asia X Japan X China ETF. And the second ETF we'll be briefly talking about is our new ETF that we're launching in July this year. Is Amova eFund China Index ETF. Just a shout out to this ETF. We were also having an IOP promotion for this ETF with FSMOne now. So without further ado, let me just begin. So before we begin, let me just address the elephant in the room. What is this Amova that you're seeing here on the screen? So Amova is actually our new name that Nikko Asset Management is changing to from 1st of September onwards. So even though the name is new, but please be rest assured, it's still the same asset manager that you all know and trust. There's only the name change. There's no change in the organizational structure, the management, or the underlying teams. Okay, so now let's begin. I think most of you are quite familiar with Nikko Asset Management because our Singapore office used to be known as DBS Asset Management. Then we were acquired by the Sumitomo Group, and now we are international asset management house with over 950 employees, over 12 regional offices. So as of end March this year, we have actually achieved a total AUM of $234 billion USD, and about half of the AUM came from the passive strategies, which is our ETFs. Our Singapore ETF has always been growing and evolving. So that's why in this year, we're launching two new ETF, like what we introduced just now. The first one is Asia X Japan X China, and the second one is China X. Or you might be thinking, why these two ETFs now, right? So let me answer the question with a few questions. Maybe first, let me just set the stage. So recently in the market, there are a lot of short-term noises in the market, especially with Donald Trump and his back and forth policies. So nobody can predict the future, and no one can even predict what Donald Trump says in his next announcement. So maybe it's better to just focus on a long-term growth and instead of the short-term jitters. And that brings us to the first question. Which of the following sector do we think might deliver the most long-term returns? Well, obviously, it's the first one, right? Technology and innovation. But do any of you know that what are the two main challenges with investing in technologies now and innovation nowadays? Well, there are two well-recognized markets for tech and innovation. The first one is US, and the second one is probably Taiwan and South Korea. But the issue with US tech names are that they might be getting more and more expensive. And the issue with Taiwan and South Korean market is that sometimes there are only a few choices for you to choose from. For example, TSMC in Taiwan, Samsung, LG, SK Hynix in South Korea, right? And some of you probably already have all the names in your portfolio. Then naturally, the next question is, where else can you go when you want to capture the growth in tech and innovation? So our second question is, which of the following region do you think might be the next frontier of tech innovation? Actually, may I have a show of hands? How many of you think it's China and India? Thank you so much, a very intelligent crowd. So yes, the correct answer is China and India. So but what are the challenges with investing in these two regional markets? The first issue, the challenge is these two markets are quite inaccessible, especially for retail investors. And the second challenge is actually for all those emerging hidden gems, there's a very low stock coverage by global analysts because these regional companies, they don't really disclose much information in English. That's why it's very hard for retail investors, especially, to gather information and to stay ahead of the market. This is also why we decided to create these two ETF this year, being Asia X Japan X China and ETF and Amova eFund China X Index ETF. First reason is that when you want exposure into Asia technology or Asia regional markets as a whole, the first issue that you face is there are very limited options. People's go-to solution is actually Asia X Japan portfolios, right? But For Asia standard Asia ex Japan portfolio, the allocation into China is fixed. As you can see on the chart, it's a very large allocation in the standard Asia ex Japan portfolio. You can't really control how much you want to put into China, but the issue with investing into China nowadays and for the past few years is that the volatility is quite high. So when China shakes, the rest of the world shakes, and so does your portfolio. But the thing is, do you want your portfolio to shake so much together with China? That's why we listed this new ETF, Asia ex Japan ex China ETF, in April this year to allow investors with more control into their portfolio allocation. So now, once you take out China from Asia ex Japan portfolio, you're left with the largest one is India, South Korea, Taiwan, and ASEAN. So you can have a more precise allocation into these up and coming markets. And then now the question is, for China market, now you're left with China market. And why China? This is because we want to provide investors with more growth and more focus to the better part of China's future, the brighter part of China's future with tech and innovation. So this one is all captured inside the China Index. Okay, now let's first look at the first ETF that I will mention, Asia ex Japan ex China ETF. Here are all the product facts. So as I mentioned just now, this one is already listed on the Singapore Stock Exchange in 2 currencies. You can trade it in USD and Sing dollar terms. And the minimum purchase unit is $1. So with this low, now it's about $1.07. So with this low amount, you can actually get access to 150 large and mid caps within the Asia ex Japan ex China index. So just to emphasize, for this index, even though it's a kind of a first of its kind concept, but it is actually focused on large and mid caps and not the small caps. Just to highlight. And next thing that we want to highlight is if you look at the management fee, so the management fee is 0.5% per annum, which is quite low as compared to its actively managed peers. And on top of that, at Nikko, we actually enhance the cost efficiency by capping our total expense ratio. Total expense ratio is actually your management fee plus whatever operational costs the underlying ETF incurs within the whole year. So at Nikko, we actually cap it at 0.6%, meaning for every $100 you invest, every year, maximum 60 cents will go into the cost. And anything beyond that 60 cents, it will be covered by Nikko Asset Management, the ETF issuer. Not a lot of companies can do that. So now let's take a closer look at what this ETF actually invests into. The chart on the left shows you the sector allocation. You can see it's well diversified across various sectors. And on the chart on the right is a country allocation chart. And you can see, let me go through one by one. So if you can see on the chart, so if you invest $100 within this index, about $30 will go into India, where we have all the India financial, all the banks and tech companies like Infosys, and then another $30 will go into Taiwan, and most of it will go into TSMC, of course. And then, following that, we also will have about 15 to 17%, which is $15 to $17 that will go into South Korea, where you have all the common big names like Samsung, LG, Kakao, or even Naver, all the tech-focused names. Then next, you have Hong Kong, about 7%. So you have all the Hong Kong financials like AIA Group, and then it's Singapore. So within the Singapore space, you can also expect to see the most common names like DBS, OCBC, or even SGX. So like what I mentioned just now, this ETF focuses only on large and mid caps. So next, let's look at how has this ETF performed. So because this is a newly listed ETF, what we have here is a back-tested performance comparison chart over the last 10 years. We use the performance of the underlying index versus its peers. So as you can see, this chart is rebased to 100. What does it mean? So it means if you invested $100 10 years ago, and what you will have now is If you invested your $100 with Asia ex Japan ex China portfolio, now you probably would have $177. And if you invested in MSCI Asia Index, you probably will have $154. And lastly, if you invested in Asia ex Japan Index, you now will have $147. So you can see the difference between the highest and the lowest one is about $30. That's actually 30% of your initial capital. So that's, I would say, this is quite impressive looking at the historical return. But for compliance purposes, I think I will only left with 5 minutes. But for compliance purposes, we have to say historical return is not an indication of future performance, just to highlight. So the next one, just to show you performance comparison on 1 year, 3 year, 5 year basis. So as you can see on the table below, is the average return for the past 1 year, for the past 10 years on average 1 year rolling basis. You can see Asia, Japan, China actually outperform the other two peers. Same goes for 3 year rolling return comparison and 5 year rolling comparison. Well, it's not very fair to just talk about performance without talking about the risk and volatility, right? So we did the same for volatility comparison as well. You can see on the chart. So even though our Asia ex Japan ex China index has a slightly higher volatility than the MSCI Asia index, but it also has a lower volatility than Asia ex Japan, than standard Asia ex Japan index. The same also goes for 3 years and 5 years. I know all the charts and numbers can be quite confusing. So we have put this risk and return together to give you a risk-adjusted return comparison. So this shows you a more balanced view of the risk and return profile of our ETF. As you can see, the blue column here is our Asia ex Japan ex China index, and the orange color is MSCI Asia, and the brown color is Asia ex Japan portfolio. Our one has the highest risk-adjusted return, which is basically return over risk. It shows you how much more return do you get for one additional unit of risk that you are taking on. So this is a more balanced representation of the risk and return profile. Okay, next. Now we have, hopefully you are all convinced that this portfolio's return and performance is quite impressive. Now let's take a closer look at what is driving this strong performance. Okay, so the first one is actually technology. Taiwan and Korea has benefited significantly from the semicon and memory chips global industries growth. So as you can see here, Taiwan and Korea have very deep roots when it comes to semicon and memory chips. Why? Because when you think of Taiwan market, what do you think of? Actually TSMC, right? And when you think of Korea stock market, what are the names that pop up in your mind? LG, Samsung, and all the technology and semicon names, right? So these two market has already been an integral part of the global supply chain of memory chip and semiconductor. So as you can see here, the global semicon and memory chip space has grown significantly over the years, from PC and internet in the 1990s to smartphones and tablet, and then to cloud computing and servers, and now it's AI, your 𝐢𝐧𝐯𝐞 and ChatGPT. Well, what's next first? What is the next big thing when it comes to memory, semicon and memory chips? We are not sure. Nobody can be sure of that. But what we are sure of is, no matter what the next thing is, it will not escape Taiwan and Korea, because they have already become a very crucial part to the entire supply chain. So Taiwan and Korea will continue to benefit from the rise of technology. So the next trend that contributed to the growth is actually coming from India. Well, I think most of us knows that Indian market and Indian economy has been growing significantly over the years. And do you know that even the India stock market has been growing as well? So this chart actually shows you how MSCI India's earnings per share has grown over the years. As you can see, in the past 20 years, it grew from 20 to 120. That's 6 times growth. And it has a potential to actually reach 140, which is 7 times. And do you know how much S&P 500's ROE has increased over the same period of time? Only 3 times. So that's quite impressive. And we are also expecting to see more growth coming from India. Why? It's because in recent years, more and more tech names have come to market within the India equity space. So as you can see, we have identified 4 key themes, namely internet economy, hardware technology, new energy and EV, and lastly, fintech. So I will not go into details in the interest of time, but you can see we have 2 bars for each chart. So the bar on the left, the shorter one, actually represents what India market is at now. And the bar on the right, the taller one, actually shows you what China market is now. So China market is often used as a gauge to see the growth potential of India market because they have a similar size in terms of population and demographic. So that's so the bar on the left is where India is at now, and the bar on the right, which is the China market now, is where we are hoping the India market will become in the future. And last but not least, closer to home, the last growth trend is actually within our ASEAN market. So what you're seeing here is actually a positive circle of growth within the ASEAN market. Why? It's because, for example, on the left-hand side of the circle, you see the trends of rising industrialization. And the chart on the right actually shows you the trends in rising consumerization. These two actually feed off each other and make each other even more powerful. Because when there's an increase in industrialization, it helps to increase household income, consumption powers. And with higher consumption power, the ASEAN market will be able to attract more foreign direct investment, which in turn will lead to increased industrialization again. That is the positive cycle of growth that we are observing in the ASEAN market right now. So just as a recap, so here are the 4 most important things that we mentioned for the Asia Japan X China Index. I think in the interest of time, I will just briefly cover the China Index that we're listing. So on 22nd of July, we are listing another ETF, the Amova China Index ETF, and the IUP period has actually started from 3rd of July all the way to 15th of July. We are also running a promotion on this China Index, IUP promotion on the China Index with Funds Supermart. If you're interested, you can take a look. So I'll just briefly go through the pointers because I think you're quite saturated with all the information on China today. So what is China? Maybe let me just start with what is China. China is actually China version of Nasdaq, but more. So this China Index focuses on innovators and disruptors across all industries within China's space and not just technology and semicon. So as you can see here, there are 4 key themes within the China Index. First is actually energy transition, which focus on all the EV battery makers and all the energy storage systems. The second theme is next generation manufacturing. China is known for its manufacturing in the past decade, but now they are the leader in next generation manufacturing, riding on the back of the strong policy support. And the third theme that we've highlighted is healthcare, life science, and medical technology. And the last but not least is smart infrastructure development for both digital and physical infrastructures. Okay, so this slide actually shows you why the 4 themes that we've identified just now will be the key beneficiaries of China's policy growth in the next 10 to 20 years. So as everybody knows, China only has one ruling party, so it gives it an advantage when it wants to implement long-term policies. China is known for its capability to implement long-term policies within a very short period of time. So I think many of you have heard the story when during COVID time, when COVID just started in China in 2020, China government actually built 2 very huge emergency hospitals in Wuhan city within 10 days of time. That's how efficient they can be when the government wants to achieve something. They are able to mobilize the entire nation's resources and manpower to just achieve that goal. So what are the 3 goals? The 3 goals that China government wants to achieve in the next 10 to 20 years? First one is dual carbon. China government wants to achieve peak emission by 2013 and then achieve carbon neutrality by 2016. This goal will actually benefit, okay, time is up, but okay, I will just finish. So this goal will actually benefit the first and second theme, which is new energy transition and also new energy transition and also smart infrastructures. And the second goal that China wants to achieve is Vision 2035. This one is actually a broader strategy to improve the China economy as a whole and achieve leadership in innovation. This one will actually benefit both the smart infrastructuring, automation, as well as medical, healthcare, and life science sector. The last is Made in China 2025. So now China wants to be self-sufficient in all the technologies and EV sectors. So one of the success story of this Made in China 2025 is actually the rise of CATL. So if you want further information, you can approach me at my booth outside. I'll be there until maybe 5 p.m. And if you want more information on the IOP promotion that we're running now with Fund Supermart, you can also approach me. So I will be covering this one later at my booth if you want. Yeah. For compliance purposes, I think I will just flash the disclaimers and important information here for you to see. Yeah. With that, I conclude my presentation. Thank you so much for your attention.